What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies. And if you stick with me towards the end of today's video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. Kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've certainly got an indecisive doji. The upper wick is roughly the same size as the body, which is also roughly the same size as the lower wick. I would say that the lower wick is slightly longer than both the body and upper wick, but overall, this type of structure leaves us with more questions as opposed to answers, right? At first we were higher, and then we were lower on the CPI gap down, but we rallied to close the gap, and then on Friday we moved back lower again. All over the place, right? Technically, we do have a red-bodied bar, so the open was here, the close was down here, so I would say that the bears probably have a slight upper hand, but overall, I'm not really that impressed with the sellers, right? Technically, we flushed the 2-week lows in here, and we could not hold underneath that level, which kind of directly ties into location, so let's cover that as well. So question mark in terms of structure. In terms of location, on the bar-to-bar count, yes, we do have a lower high as well as a lower low, so I would say that the bears do check out there in terms of showing some signs of strength. But again, this close being right on the flush point, right on the breakdown point, does strike me as more of a question mark as opposed to, okay, the bears are clearly running away with it, right? I would say sellers probably still have the upper hand anyways, just because the weekly trend is down, right? We've got our lower highs in place. We've been counting our trend the past couple of weeks. This upper wick here did count as a lower high, and technically we just breached and made a new lower low. So can we afford some sort of lower high in here again? It's possible, but again, I'm really struck with more questions as opposed to answers here from this weekly structure that we've been looking at. So I think the appropriate response is to be really flexible this upcoming week and not be married to any particular direction, which really proved to be the right mindset to have on the CPI gap down. So anyways, we'll talk more on the daily time frame chart, but for now, I also want to show you the high volume nodes. Where are we from that perspective? So 340 continues to be the node to the downside to keep an eye on. Technically, it's 339, the reset high from background in here, and we do continue to reject the upper high volume node here, which again is not quite on par with the amount of volume that we've seen in these areas, but overall, the continuous rejection there would again give me a slightly more bearish feeling on this particular chart. Being in the low volume node, we know that we should be gravitating towards one of these areas, and with 2 rejections off the upper end now, remember last week's upper wick as well, I would say that 340 could very well be in the cards just based on that type of analysis here. Let's continue on down to the daily time frame and start talking about tradable levels into the upcoming week, some scenarios. Remember that flexibility is probably going to be your friend in this upcoming week's worth of trade. And let's talk about why on this daily chart right here. So first up is the expected move. Expected move did shift lower, so we are in store, if we stay contained, to produce a lower high, kind of an equal high, actually. Let me correct myself there. Kind of an equal high to what we saw here on Friday. Notice that that's right here, or a slightly lower low. So really, I mean, it's just a volatility storm out there in the marketplace. We know that the CPI print missed. It was above expectations. So boom, we got the gap down, but we rallied. Hopefully you were there on the pre-market live stream. We covered that. And then we also caught a short live on stream on the Friday session. But regardless, again, we're up, we're down, we're all over the place. I think that the bears have the slight upper hand as well, because if we think about the structure, this sort of balance area here, we know that 360.75 was playing a key role. At first, we closed above on Thursday. Now we closed back underneath on Friday. So, I mean, all over the place. We're right back at this area of support here, technically underneath the balance area from there. So again, maybe the bears have a slight upper hand, but why was it that the response was so severe to the CPI gap down with all of this buying pressure? It's not like there was no volume that took place there, right? So overall, flexibility is going to be your friend, and I would just keep these rough areas in mind until we start getting direction this upcoming week. Top of the weekly expected move. We also have rejection points in here, bottom of this 3-day balance, top of the prior balance here. It's a lot of stuff. That's roughly around 370 up to 371. Give it about $1 worth of range. That's nothing in a market that's been trading, up 10 points, 15 points in any given day, down 8-10 points the next day, right? So a dollar range there isn't going to hurt anyone. Use that as your upper limit. The bottom is going to be right here. That's kind of what I would focus on, around 356.75. That would be kind of, if we stay above neutral, kind of in this overall balance range, you could just expand it and call it something like this now. If we poke underneath that, okay, definitely starting to feel a little bit more bearish. Maybe the sellers will run away with it this time, but we'll ultimately have to wait and see. Again, that number is 356.75. Now, you might also notice I've got some yellow dashed lines on the chart today. That's because we've got some single prints to contend with. We'll talk more about that on the market profile charts. But if you're a really nuanced trader and you want more granularity, I would say that the SPY would actually be slightly more bullish if we can get up and over 363.50. Up and over 363.50, this is slightly more bullish acceptance above that level. We'll talk about the singles again on the market profile in just a moment. And if you want to be more granular to the downside, you probably want to wait for a breakdown of the single prints from Thursday at 354.75. If that's way too in the weeds for you, again, just keep it simple. We're neutral underneath 370. Would just play ping pong back and forth in here. We're slightly more bullish if we get a higher low up above. And if we break down out of the balance area, lower highs underneath that 356.75 are probably what you want to focus on. So this market is very, very tricky. Volatility has not gone anywhere. We'll talk about the VIX in just a moment. Be open, be flexible, do not get married to any particular direction. I think that type of mindset will serve you well in this current market environment. I mean, you can talk to many, many people out there right now who are saying this is unlike anything they've seen ever before in terms of just the sheer amount of volatility. Let me share with you a couple of Fibonacci perspectives. I think the main value in today's video is, again, just reinforcing the idea of staying flexible. There's not too much I can tell you from a technical perspective based on what's going on here, other than, okay, the bears have a slight upper hand based on what we explored from the weekly chart, right? If we come in with the fibs from here all the way down to the low, notice that your upper edge, that 38.2, is coinciding with the upper edge of the weekly expected move, that 370 up to 371 zone. So I would still carry that forward as significant resistance. Bears are in control underneath that level. And it doesn't really make sense to come in with fibs from here to here. I mean, you're just dealing with a ton of chop in the midpoint there. I would say we're back underneath the 38.2, so slightly more bearish than bullish. The last fib perspective I really want to share with you is something that looks like this, perhaps better on an hourly chart, actually. Let's try that. So here's an hourly chart, right? If we were to look at this rally from the CPI move, we want to grab the fib tool and move from the lows up to the highs, notice that this is not just a healthy pullback, which took place on Friday. We actually breached the 38.2. We closed underneath the 50%, and we're coming into the 61.8. But because of that, the 61.8 is perfectly aligned with our 356.75, right? So you can see how multiple confluences here make this number important as well as this zone important as well, which is why those are the main focus areas for this upcoming week's worth of trade. I think it's going to be a patience play. It's a flexibility play. All of those things we've been kind of harping on so far. Let's take a look through the sectors and see if anything is interesting from that perspective. Let's go back to the daily charts. Here we go. XLY is up first. What do we see from the consumer discretionary perspective? Finally playing catch up. It's at and slightly, not quite slightly below, but at the June lows. Remember, it was relatively strong for quite some time. So this reversal all the way back down to the lows strikes me as okay, kind of just poised to continue lower with the remainder of the broad market. Much more give back on the Friday session here, not as much holding power from the Thursday rally to the upside. Bearish chart, obviously, right? So continued price acceptance under 137 does strike me as bearish. The only time to get bullish in this chart is a higher low above 140.25, and obviously any breakdowns of 133 even bring you about $3 lower to our next target here, 130.25, and 123 after that. Quite a ways to fall if this zone of support fails to hold up in the upcoming week. So to me, this is much more of a bearish data point for the overall market. Next up, XLB material sector, much lighter weight sector, obviously not holding up at this 68.75 anymore. I would just say that this is likely to continue lower based on the failed pullback from Friday's session, giving back much more than we would have liked to see. But again, lightweight sector, it's not going to make or break the market. Same thing with real estate, lightweight sector, obviously bearish. It opened on a gap up above the top of this balance after the big rally from Thursday. No holding power, no sticking power, rotated lower. I would expect lower out of real estate, especially with the nail in the coffin and CPI kind of solidified that, yes, we will be getting another 75 basis point rate hike. We'll talk about that as we get to the TNX in just a moment. XLK, obviously the heaviest weighted sector of them all. Let's take a second and think about it. Here's a balance range, right? What happened on Thursday? We just barely backtested the bottom of the breakdown point from in here. On Friday, we could not hold up above that 119.75. Strikes me as bearish, right? It would be reasonable to look for the equal low again at 113.40 roughly, and then get continuation to the downside. So overall, being the heaviest weighted component, this does fall more into the bear category than the bull category. If I did, if we were looking for a bullish outcome here, what would I need to see? For me, it's got to be a higher low above 122.20. Why is that the number? Because that was the original balance, right? Price acceptance underneath, this little shenanigans, we'll call it for now, and then just everything's been rejecting underneath so far. So 122.20 is your number in the XLK that we need a higher low above if you're trying to flip bullish in the market. If that doesn't happen, no reason to be bullish. Be at least neutral, slight edge to the bears as well, right? Next up, XLI. What's going on in industrials? Of course, we know 7% of the S&P 500, so not overly important, but notice how it's right back at this level around 85. It didn't quite close like significantly underneath there. I would say that the bears do have the upper hand. Again, we did open on a gap up. It's completely failed back down to the level, but if it's going to put in a higher low, this is one of those candidates where, okay, it would kind of make more sense to happen in the XLI, right? Unfortunately, again, only 7%, so it's not going to, make or break the day for the S&P itself. Here's the energy sector. What do we see from a structural perspective? I mean, just a beautiful bull flag looking chart, right? You could also start to call it inverted head and shoulders. Take out this neckline, take out this 82, 86, call it 85 if you want to go right across the top. And we're kind of off to the races in energy, which, is not going to feel good at the pump again. But nonetheless, that's not a great sign. That's not a bullish look for your S&P 500 as a whole. Sure, it's bullish pressure. It's moving in the upward direction. I'm not going to deny that. But we don't want to see energy leading any sorts of rallies out there in the market. So to see it holding up here, a little bit of a red flag. Continuing along, XLF is one of the sectors that looks like it might want to hold up. And the reason being is very similar actually to the XLI, but we know that the XLF financials is a much heavier weighted sector. And we're actually, we're going to round out bank earnings as we move into the early part of this upcoming week. I'll bring up an earnings calendar in just a moment, but there's the balance area. Notice that the pullback was not nearly as significant on the Friday session in financials. So if we turn around and hold 31, I would say that that would strike me as a decent look for your S&P 500. Probably don't look for the aggressive breakdown if financials are hanging on to 31. Now, obviously, if it fails it, you're just looking for the equal low here at 35, and then continued breakdown probably gets us closer to 29. Interesting, the CPI move from Thursday really threw a wrench in many charts. Overall, 31 is the primary focus of the financial sector. Next up, the utilities chart continuing to fall off of a cliff. I'll just continue to say that this is not a new money short being down here at the lows, but it's also not something you're trying to catch the falling knife in. I would say it's a decent look for the S&P 500 to have utilities backing off so aggressively, but again, just like we talked about in energy, upward pressure is upward pressure. Well, downward pressure is downward pressure, right? And certainly this is moving to the downside. Both utilities and energy are lightweight sectors, but they do mean a lot in terms of their defensive nature. Next up is the XLC for communications. This one strikes me as bearish as well. Could not get up and over the balance area on Thursday. Friday gap up, did not hold. Obviously, 48 is a must. If you're trying to look for a bullish entry in the XLC, 48 is a must hold. If we fall back down underneath, just continue your downtrend. You've got lower highs continuing to stack in place, especially on the back test of a level here. So it does strike me as more bearish than bullish, but I'd give it the benefit of the doubt and say 48, prove yourself early on in the week, and then we'll go from there, kind of just like your XLF at 31. Next up, consumer staples. What's going on from this perspective? Certainly much more of a choppy chart compared to many things that we've looked at so far. So here's kind of a balance range, right? You could technically go in from the top. I don't like it as much. I kind of like it here. So overall, just playing ping pong in the range. Technically tried to break out on the Friday gap up, but failed back into range. Strikes me as neutral, and obviously bears have the upper hand. If you're looking at a weekly chart, it would strike me as a bear flag here in consumer staples, which of course is downward pressure last, but certainly not least because this is the second heaviest weighted component of the S&P 500. Here we go. XLV, the healthcare sector. What's going on from this perspective? Very interesting chart. We opened on the gap up on Friday above 125. Again, no holding power even after an early morning rally and then complete collapse into the afternoon. The interesting thing here is that we've got the 124 level as well. So much more of a question mark. This one leaves me with more questions than answers. Very similar to that SPY weekly chart. I would want to be flexible in the healthcare sector and continue to monitor. Okay, early on in the week, if it's just a breakdown of 124, bearish. Carry forward a bearish stance in your S&P 500 being that this is the second heaviest weighted component. If we bounce and just kind of go sideways here, I don't know, maybe there's something to be done on a recapture of 125. We flip back to at least neutral to slightly bullish in the S&P 500. I would just watch this zone like a hawk until it really resolves. This is not much resolve. We want to move away from this and form a higher low well above, or just give us the breakdown, like one thing or another. This is not a trending market in here, which is why it's been so tricky, back and forth, back and forth. So again, I can't reiterate, I can't underscore that today's video is all about flexibility and not being married to outcomes, especially given the situation of almost all of the charts that we've looked at so far on today's session. Here's the ratio grid. If you don't know what this is, top right-hand corner shows you how to set it up. Let's do a quick interpretation and see what this is telling us. So top four are the risk on heavyweight sectors. XLK continues to fall off of a cliff. Without this pointing in the upward direction, you're not going to have a risk on marketplace. So right off the bat, risk off from that perspective. The XLY is starting to fall off of a cliff. We know that it's basically given up its relative strength, so that makes sense here from that quadrant. XLV, we know that XLV is the second heaviest weighted component of the S&P 500, so we need it to participate in upward rallies. But guys, don't forget, and I've said this in the past and I'll say it again, the healthcare sector is technically D4 defensive. It's just a heavy weighted component, so we do want to see it rallying with the market, unlike energy and utilities. So anyways, seeing XLV rally to the upside makes sense, given that we're kind of just stuck sideways in that range that I was just showing you on the daily time frame chart. Here's the XLF pointing in the upward direction, again with the possible higher low at 31. This would make sense. If the XLF holds up at 31, okay, decent look there. So again, 2 of 4 pointing upward aggressively, 2 of 4 pointing downward aggressively, with one of them being the XLK. Pretty tough to have a risk on look based on that perspective. Bottom 4 are the risk off sectors, the lightweight sectors, the defensive sectors. XLP, kind of trendless, higher high, lower low, lower high, kind of just choppy here, not telling us a lot. XLE is saying risk off. Utilities is like, okay, but I'm kind of being fine down here at the lows, more of a risk on look. So just confusion out there, which again aligns perfectly with the message of today's video: be flexible. Let's continue along. What do we have after this? It's none other than the TNX. Here is the 10-year interest rate. And what do we see from this perspective here? Obviously, this continues to move in the upward direction. We know that the rough relationship is that the market likes number 1, lower rates, or the market likes number 2, stable rates, sideways. This is not lower, and it, of course, is not stable going sideways. Looks like it can continue to the upside. And as I was saying earlier, the CPI print really confirmed what's going on here from a Fed rate hike perspective. So here is the anticipated move for, let me get the black arrow out, there we go. This is the anticipated move for November, right? We're expecting a 75 basis point rate hike. We're sitting at 300. Market is expecting and pricing in 375. If we go out to December, if you go back and watch prior videos from the channel, you'll remember that this column here looked like this, and this column here looked something like this. You can clearly see a shift in that now that CPI came in hot. We're expecting that the Fed will continue to raise rates at this 75 basis point pace that they've been doing for the past couple of meetings here, which the market obviously did not like from the gap down on Thursday, as well as the sort of move lower on Friday as well. So overall, that's kind of, keeping tabs with the Fed, if you will, and what's going on with the TNX. Overall, obviously downward pressure for your marketplace, meaning that we're slightly more bearish based on this information as well. Let's take a look at volatility now. This was the real giveaway on Thursday's session that we were not out of the woods, right? If you look at the VIX here, this is Thursday's bar. On a market rally like what we saw on Thursday, if that was going to be it, if that was going to be the end of the down move, we should have seen the VIX collapse like what was going on in here, like what was going on in here. It just wasn't the case. It was a mild down day. We even had a better down day in the VIX here on that first initial, not June low, but the retest of the June low in early October, right? So overall, the VIX is saying, hey, volatility hasn't gone anywhere, right? That felt like an impressive rally on Thursday. There was some short covering going on. There was some new money buying going on. We know that from the internals, right? But overall, volatility is here. Look at this as a box and look at this as a box. We're not even close to coming back down into box number 1, never mind being at our 2050 floor, where we know that markets are feeling a little bit more comfortable. So volatility is still out there. And again, flexibility is the key here. Let's take a look at the VVIX, the volatility of the volatility index, to see if people are hedging. And yeah, there is continuous hedging activity taking place here as we hover around the 103 zone. I would just remind you that this was kind of like the sickness era. Let's go ahead and grab some more time here. This is This is important, right? So this is the sickness era. Notice how we built a floor at 103, but in the past, right, if we look even further, sorry, we've got to keep grabbing more years. I just want to make this clear, right? If we look even further in the past, the floor used to be kind of around 85, okay, is what I'm getting at. So this, as a read, although it looks lower in comparison to up here, it is elevated based on historical perspective. So yes, there is some hedging activity taking place, probably not as much as we'd like to see given the state of the S&P 500 as a whole. Let's take a look at the VIX now. And the takeaway on that, by the way, is just that, yeah, if everyone floods into SPY puts VIX calls, you're probably going to get one of those gamma squeeze moves where things get out of control real fast. Anyways, from a volatility futures perspective, we are still in backwardation, meaning that this is inverted with this. There's more risk in the present day on the active October contract than there is on the November contract 31 days out. Again, just an indication that volatility is among us. It hasn't gone anywhere. We are not out of inversion. We are not out of backwardation. There's no contango. I know those sound like fancy words, but as long as this number is higher than this number, you know, hold on tight because we're in for a bumpy ride is basically what this is telling us, right? Let's go ahead and take a look at the market internals now and see if this is giving us any additional information here. If you don't know what this screen is, top right-hand corner is a tutorial on how to set it up and how it'll help you make better intraday trading decisions. So here we go. The main takeaway is basically that, you know, the Thursday rally from CPI, yeah, there were some really significant volume reads out there, over 300 million at the end of the day. But look at what happened on Friday. Just as significant outflows as we closed out the week underneath negative 300 million. I don't want to say that they directly cancel each other out, but if Thursday was going to be the start of new money buying, we shouldn't have followed that up with a significant outflow of the market. Same thing holds true in the advanced decliner. Look how we really crawled from a terrible opening printer in the advanced decline all the way up towards the top. And then on Friday, we undo that entire move, another indication of volatility, right? This is buy everything out there. And then the very next day, it's sell everything till we come back down to trend zone at and around negative 2,000. Volatility, flexibility. How many times can I say it? Drop me a comment on how many times I've said the word flexibility in today's video. And I don't know, there's probably not going to be a prize, but you know, I'll say something nice to you in the comment section. How about that? Outflows from a tick perspective. This isn't outflows, but rather just the aggression in the tick. Yes, certainly would confirm the downward move from Friday's session. Let's take a quick peek now at the market profile because I think this is interesting here. Let's go full screen ES. There we are. And if we just scrunch this chart up, this is interesting because we've got single prints, and I was referring to this on the SPY daily chart, right? We've got single prints here from the Thursday rally, and this is indicative of short squeeze. Absolutely, no doubt about that. Notice how we look into it on Friday, but we don't really travel through it with ease, right? You would think that there's not a whole lot of volume here, there's not a whole lot of structure here. The market should have moved through that with ease. So is this going to hold for a higher low? I don't want to guarantee that based on the failure from the sellers to push it back lower again, but it's just another one of those question marks in our analysis for today's session. And, you know, obviously we've got single prints up here as well, so let's discuss those. This, to me, is much more of like liquidation break. You've got longs trapped up at the highs. Everybody saw the rally from Thursday. You've got longs in the overnight session who are clearly participating at the highs without follow through. You know, to me, all of those longs closed out, not wanting to hold over the not the long weekend, but the weekend in general, as soon as we kind of move underneath the prior high of day and, you know, we get price acceptance on the lows. Value area is lower. Obviously, point of control is lower. So again, very, very emotional market out there. You can just see that in the ranges that we're traveling and the single prints that are out there. And this is one of those levels that you want to carry forward as important. That's what we're discussing on the SPY chart, right? If we can move back above that, that would be an indication that, okay, you know, maybe things are getting slightly more, at least neutral, maybe, dare I say it, bullish. If we can move back above those single prints, it's a possibility and something to be mindful of here. But again, flexibility is the key as we move into this week's trading session. Let's get back on over to the platform and round out the rest of the broad market here. Let me tame this back down to a yearly chart so we don't have too much data to look at. QQQ, NASDAQ 100, what's going on from this perspective? We'll go front and center with the price action. Same idea as the XLK. Your balance range is really overhead. We tried to look into it on Thursday. We failed to hold the gap up, and we closed back down underneath on the Friday session. So to me, the critical numbers here in your QQQ are going to be 267.50. Any rejections of that strike me as bearish, right? You can look for breakdowns underneath the low of Friday, basically at 261.25. Your bottom of single prints are going to be right there as well. well, roughly 260. And then, of course, your gatekeeper is just the low of the gap down from CPI. That's going to be around 255.25. Anything underneath that, lower edge of the weekly expected move, and next target are closer to 247.65. The psychology here is definitely more bearish than bullish compared to what we just discussed in the S&P 500. You can clearly see that based on this overhead balance. So if this is overhead supply, if this was a rejection for a lower high, which it certainly was, right? This is just a lower high, then we can look for lower here in the QQQ. I would say that this is weaker than your S&P 500. Next up, we've got, last but not least, IWM Russell 2000 and the small caps before we dive into the companies. What do we see from this perspective? This one continues to be the relative strength monster, just because it has never broken down or spent any time underneath the June, not only the June lows off to our left, but the lows from late September, early October here. You know, sure, we gapped down into it on the CPI print, but immediately rallied outside the range and then just fell back down to the midpoint of the range on Friday, as opposed to everything else being slightly more bearish. So this one, again, continues to be a head scratcher, just another testament to flexibility. What is that, like 10th time I've said that word today, maybe? I have no idea. Anyways, levels you're going to want to pay attention to in the IWM are going to be your 169.20. If we can pop back above that for a higher low, that starts to look a little bit more promising, something of the sorts. I wouldn't bet on it quite yet. Obviously, the weekly structure wants to form a double bottom like this before we're bullish. That's 177, way outside of the weekly expected move. Wouldn't count on that this upcoming week. And if we do move lower, this is the gatekeeper, right? Treat this as a zone, 163.75 down to 162. If we give that up, okay, there's a gap to fill underneath us. I know it's faint, but it's from 157.80 down to 155.70. If IWM, if Russell 2000, the small caps, does want to play catch up to the remainder of the broad market, this is likely where it's going to go if we get a flush of these lows, right? So that's what I've got in the broad market. Let's dive into the companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that, we'll dive right into Apple. Again, a pretty tricky chart, giving us a solid green-bodied bar, failing the breakdown of these lows. There was no back test for a lower high, nothing. And then we failed on Friday, right back down to the breakdown point. So this is a pretty tricky chart to trade here inside of Apple. I would say that if we get continuation under 138.25, obviously the target is the Thursday low. If we don't make it there and we turn around for a higher low above, that makes things even more complicated. The only time that I would say, okay, buyers are finally starting to step up, I'm feeling more confident in longs, is if we can get price acceptance with higher lows, structure that kind of looks like this, over 143.40. Anything that just plays around in here, I would try to stay away from, to be quite honest with you. I don't really want to get involved in the chop in that overall range. Next up, we've got Netflix. Big sort of, again, confusing chart here with the, failure to hold underneath these lows at 221.50, right? We broke down on the Tuesday session, Wednesday accepted underneath, Thursday, boom, right back up to the 234. Tricky chart, very tricky chart. So to me, this is kind of a patience play. Take it step by step. Now that we're back down underneath 234, I would say, okay, technically these people are again turning into overhead supply. They had their chance to get out for break even. If they continue to sell early on in the week, we're probably looking for lower. And I suppose now is actually a great time to bring up the earnings calendar. Here it is. Obviously, Netflix is reporting after the bell on Tuesday, which is the reminder that I just had there. But anyways, you'll notice that we've got some banking stocks early on Monday's session. Tuesday session, J&J is a trade idea for later, so just be aware that they're Tuesday before the open. Tesla is after the close on Wednesday, so is IBM, and Alcoa is something to watch as well. After that, we've got Snap as a tech company on Thursday. American Express is a decent trader as well. Nothing else really catches my eye. Some people like to trade the airlines. We've got American and United as well here, but overall, the main things I'm focusing on, I'll just put a quick asterisk next to them: Netflix, Tesla, maybe Snap, and that's really going to be it. I'm not really going to focus on any of the smaller players here. Bank earnings will just give us an overall indication as to whether or not the XLF wants to hold its 31 level. But back on over to the charts, Netflix, as you can see, earnings Tuesday after the close, playing around in this choppy range. I don't really see a reason to be overly aggressive in Netflix early on in the week until earnings have passed. Here's Tesla, another earnings candidate. As we know, big bearish engulfer on Friday does strike me as clearly being more bearish than bullish, being in an overall downtrend as well. Kind of in no man's land here, but any failed lower highs, you can start to but get down towards 194.50, 182.65, and dare I say it, closer to 169.25. That seems like a stretch into the upcoming upcoming week, but anything can happen on earnings, so do be aware of that. Let me give you the quick earnings spiel. Day trading earnings is fine. Just be prepared to pay higher prices because implied volatility will be pumped up. Swing trading short time frame options through earnings, that's a no-no for me. You can do whatever you're going to do, but let me quickly explain why. Before the earnings comes out, you will have an IV increase in the options. As soon as earnings comes out, the number is actually released, you'll have an IV drop off. Everybody knows the secret. There's nothing to know anymore. Implied volatility decreases, right? You also have theta working against you. So when you have two things working against your options premium, I will not be a swing trader of weekly options through any earnings announcement. Unless you're willing to lose the entire investment, it's just not worth it. You could even get the direction right and still be left with a loss based on implied volatility crushing and all of that value being sucked out of the option. So anyways, those are the downside numbers in Tesla. The chart does strike me as more bearish than bullish. The only time to be bullish would be higher lows above 221.50. So time will tell on this one. Next up is Google. No earnings this week, but certainly the week after that. Let's get a zoom. Can we think or swim? There we go. Certainly, if we're looking for the double bottom, if anyone's bullish in Google, which I would not try to be, given that we're back at 96.25, but obviously your neckline's way above at 103. It's kind of off the table for now. Here's a balance range. If we break down from it again, I would just retarget your 94, and anything underneath that goes to 90.10. That's the larger breakdown that I would try to trade for if we're bearish in the upcoming week's worth of trade. Next up is Meta. What's going on in the metaverse with Mark Zuckerberg? Here's your bear flag. Is it panning out? Absolutely. Based on a measured move, we can probably head down closer to that 114.50. Earnings are further out on this one. The lower high was beautiful on the Thursday rally, being underneath the bottom end of balance right here. So that did constitute a nice lower high. I would say that Meta would be a candidate for lower based on the structure being much more playable than almost everything that we've looked at thus far. I would watch this level as a possible entry point close to 127.40. First target is Thursday's low. Then you can walk down the targets 119.50 and 114.50 that we were just discussing. If it's upside, it's got to be a higher low above 134 before flipping in the bullish direction. Next up, NVIDIA. What's going on in NVIDIA? Taking a quick look at this chart, it again strikes me as a little bit more tradable than some of the other things we've looked at, like Tesla with that outside bar. But nonetheless, the reason being is there's your balance range. This is clearly a lower high underneath that 122.50. So watching for some follow through now that we've closed Friday underneath 114.50. Equal low could be on tap. Anything after that, we're looking at 98.50. So I would carry forward a more bearish stance in NVIDIA. Playing around in here, I would want to see continuous lower highs on an intraday basis. And then anything that's a higher low above 122.50, maybe we can change our stance above there, but I don't see a reason for it based on Friday's close just yet. Next up is Microsoft. What's going on with Bill Gates and Softy here? Taking a quick look, again, very tradable action. Clean retest of the bottom of the balance from here to here. So if this is going to constitute the lower high on the daily time frame chart, something that looks like this, then game on, right? We have a trade to work for to the downside. I would say patience in this range, and then breakdowns of 225 get interesting to the downside. If we go to the hourly chart, reason being, right, we've got some structure from in here, but as soon as that level goes, it's thin, right? We've just got that short squeeze early on from Thursday's CPI gap down. So under 225 gets interesting to me here inside of Microsoft to retarget the Thursday low, 219.13. And then after that, the next technical targets that we have based on structure are 216.50 and 212.15, one at a time there. And Microsoft higher lows above 235.10, flip the trend here based on something like this taking place and being back inside of the balance area. But again, Friday's close does not strike me as a high probability just yet. Last but not least, we've got the mini beast. What's going on here with the mini beast? We'll quickly zoom in, and what you'll notice is very similar structure. So this one does strike me as being more tradable, unlike Apple, unlike Netflix, unlike Tesla. I would say everything else on the list here is much better in terms of structure. But anyways, you've got your lower highs in place, retested the bottom end of the balance, right? We've closed weak towards the lows. If we take them out, look for continuation 102.50 and 98 after that. To be bullish, you've got to see your higher low above 112.50. Hopefully you can see a pattern through today's analysis. And what I'm going to do is say flexibility one more time for anyone who thought that they were going to get away with sort of being done for counting. Anyways, we're going to continue along trade ideas. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all those buttons YouTube tells us to tell you about. And let's get directly into JP Morgan as our first trade idea. Earnings are out of the way. They happened on Friday, right? And what we're looking at here is a nasty inverted hammer that rejected the 50 SMA and is also producing a lower high from the daily time frame perspective. If you were to think about this on the weekly chart, it could have looked like a double bottom and your neckline would have been here. Notice that upper wick is a clean rejection of that neckline breakout. So to me, buyers are weak, sellers can step back in and move this lower here to preserve the daily downtrend. So underneath Friday's low at 110.75, look for a rotation into 108.43. That's probably a day trade. And then swing traders can look for the equal lows much closer to 104.37. Next up is another bearish trade idea in the banking industry, Morgan Stanley. This one's an inside bar where you'll notice that we've got a lower high as well as a higher low. So if we break that inside bar low, which is basically a 2-day low at this point, 74.87, look for the break to bring us to the equal low from the weekly perspective here at 72.50, right? That could be a day trade, or it might take a little while longer to play out considering that earnings volatility will settle down just a little bit. I'm not saying a ton, and it might take a couple of days to get there. But regardless, bearish trade idea here inside of Morgan Stanley. Last but certainly not least, we've got Johnson & Johnson. For all of you bulls out there, earnings are around the corner. Remember, I did bring up that earnings calendar for a reason, but look at the inside bar, beautifully poised in the upper half of the Thursday rally. If this is going to get a break of these two highs, so you've got high set here, let's look for the rotation higher after that. I mean, we might get hung up around 167.75, these upper wicks and rejections from there. But really after that, there's some clearance until this technical level, which I think is so clean, prior lows, break, retest, and lower right off the number, closer to 170, right? So day trades, yes to here, and then swing traders probably want to look for a little more closer to that 170 mark. Not really interested if this breaks down underneath Friday's low for something that does this or just stays choppy in this overall range without breaking those two highs that we just discussed. So overall, that's what I've got for you for the weekly watch list. If you enjoyed the video or learned anything new, stay flexible. Let me know how many times I've said that word in the comment section, or give the video a thumbs up. And with that being said, I wish you all a green trading week.